I think one of the reasons why most folks are a little skittish or scared to invest in rental properties is not because they don't think that the returns on investment are there, or at least the ones that are projected on these evaluations, right? The numbers tend to look pretty good when you're talking about real estate, right? Mm-hmm. They look better than the stock market typically, right? Mm-hmm. But the reason why most people choose to invest in the stock market, stocks, bonds, mutual funds versus rental properties is because they just don't know that it's actually going to line up that way, and it's not going to be underperforming, and that it's going to be hard for them. If you can get to the point where people think of this as an enjoyable experience and they have confidence that the numbers are actually going to shake out that way, then you've laid the foundation for somebody to take a lot of action, buy rental properties, and start to build that portfolio. So when we think about what the role of the property evaluation is for us here at JWB, it is making sure that we lay out very conservative yet realistic expectations for how we are going to handle your money. And, you know, the question of like, what are we projecting should come up in people's minds. I don't know if people have ever asked this of another service provider, but most service providers, I'm going to generalize here. If you ask them, what am I projecting as far as the ownership here? They probably don't know. They don't spend a whole lot of time thinking about the numbers they put on this evaluation because most of them don't have access to the information. But, you know, the numbers that you're putting out here can be very different if you're talking about a 1-year hold or a 5-year hold or a 20-year hold, right? So we look at this property evaluation and we say the minimum period of time for an investor to hold on to a JWB asset should be 5 years. Right? Investors own the assets outright. Technically, they could sell the property at any time, but our job is to set them up for success, and setting you up for success as a rental property owner means holding on for at least 5 years because it's expensive to sell real estate. We want to make sure that you're in a position to prosper here. So if we know that, then our projections here are based on a minimum hold period. So all of the numbers that we look at here are based on if someone who's buying this property today, what would they most likely see over a minimum hold period of 5 years? Well, if you're thinking 5 years in the future, again, this would be a great question for others to ask other service providers, because if you're thinking 5 years in the future, well, you should probably think about the economics in the marketplace for where we are today, next year, over the next 5 years, right? Where we are looking as far as inflation over the next 5 years is very different than where we were over the last 5 years.
Makes sense.
Is that going to impact your evaluations? Yeah, right. So, you know, we sit down routinely and we analyze 3 things when it comes to our property valuations. We look at historical performance. We talk a lot about how we have the data flywheel that I know you're a big fan of.
Big fan.
I dropped data flywheel in the episode, so I've hit my quota.
I'm good now. I'm good. I'm here for it.
We look at historical performance. We have tracked all of our clients' properties that have been purchased for us with us since 2011. There's 2,500 homes there that we have data on. So we can look at that historical. We also look at what has happened most recently, right? We look at the most recent year's data and we say, okay, that's also a great source of information for us to look at what's recently happening. And then we look and we say, okay, where is the market? What do we see? What economic factors are out there that may influence some of these numbers? We put it all together. We sit down, we hash it out. And after the course of many weeks, we can walk through some of these changes, which is what we're going to do with you guys here today.
Awesome, man. Thanks for recalibrating me there. I was going straight in for the kill of just like 7-point bullet point update. But I remember this whole conversation, how we framed it. I think it's really, really valuable. This idea that there is kind of like 3 sets of information or 3 pools that inform this property evaluation. The backwards looking data, the what's happening right now, and then the experience-based, what we think is going to happen based on having been through other cycles, based on managing people and properties and all this other stuff, right? So there is,
absolutely,
it's got to be informed by all 3 to have the most complete picture.
Yeah. And something else that should be worth noting, if you're only buying a property from an individual seller of properties, they're not doing the property management, they don't really care about a 5-year hold because that's going to be the property manager's problem. Mm-hmm. That's not their problem.
Yep.
So, you know, the fact that we look at all three is really important. Why do we do that? Because we are going to be here 5 years later when we look at your returns on investment, and we're going to see how we did. We're going to be here every month along the way when we see how we did as well. So, you know, you got to go back to motivation, incentives, right? We want to keep you happy so you come back and buy more properties with us. Alignment of goals at the core of this is why we go to such lengths to prepare clients the way we do.
Cool. Let's get into it, man.
Okay. Movie voice.
The 7 adjustments on the property evaluation. Number 1.
Love it. Love it. It especially plays really well when you look at my really intimidating sweater that I'm wearing right now. This is great. All right. So the first one we're going to talk about, for those who have been following along on the Thursday show, which is the property of the week, I would absolutely encourage you to continue to show up for that one. You guys will be aware of some of these. Number 1, we no longer are separating maintenance costs as a percentage for renovations that are on septic versus renovations that are on sewer. Prior to this, based on our data, we would separate this because renovations, properties that are renovated that are on a septic tank tend to have higher costs than if it's on city sewer. That has been proven over the years, and you guys probably know that from your experience as well. Well, one thing that we implemented this year earlier, which has been a real big success, is our septic warranty program. So now any property that's purchased and has a new septic tank in that property, whether it's new construction or renovation, all comes under the septic warranty program, which means if there is a loss on your septic tank or the drain field, or there's a problem, guess who pays for that, Pablo?
The resident.
Well, the warranty company.
The warranty company.
Yeah, it's not on you. Yeah, even better, right?
Yeah.
The same company that puts it in the ground is the same company that's motivated to make sure that it performs. And if there's a loss on it, they, of course, are on the hook, which is what we love about warranties. Again, alignment of goals as well, right? And then even better than that, the resident picks up the monthly premium for you. So as a JWB client, this is an example of you getting an incredible amount of protection without having to pay anything more. And how often does that happen?
Only in the best cases.
Only in the best cases with the best companies, right? It doesn't happen often. So the resident pays the insurance premium, the warranty premium. And if you're wondering why this is a win for the resident, well, think about it this way. If you are a resident, you are assuming that you are going to pay the sewer bill, right? And if you are paying the sewer bill, whatever that may be, $50 a month or whatever, $100, I don't know what it would be, right? Whatever that would be. Well, now, if you're on a septic tank, you technically don't pay that prior to this warranty coming into place. Now it's positioned in a way where whether you're on sewer or septic, the costs for you are basically the same as a resident. And of course, that protection gets built in for the owner. So everybody wins here.
Got it. And that's this update. That is this program that we rolled out that we've talked about. How does that relate to the property eval sheet?
Well, so now that we know that the big losses for for septic tanks are no longer a cost to clients, it's reasonable to assume that the renovation maintenance costs for sewer properties are going to be the same for renovations that are on septic because you've removed that big cost variable. So no need to complicate it anymore. We don't separate renovations that are on septic versus renovations on sewer. If you're wondering, in the past, renovations on septic had a 9% maintenance rate. They do not have that now. Renovations for sewer in the past had a 6% maintenance rate. Now it's all one, and that's kind of a prelude to our next one, which is showing that maintenance rate of 7.5%.
Number two, adjusted maintenance cost.
Thank you very much. We adjusted this. So as I mentioned, it was 6% for renovations that were on sewer before. Now all renovations, again, are going to act the same. But we have raised this from 6 to 7.5%. And, you know, nobody likes maintenance cost raising, right? Our business is built on keeping those low. So it's not something that we want to do. But the reality is that we're in inflationary times. And I think everybody has heard about increased costs of labor and materials in the construction world. I mean, the cost increases are substantial. And so as we think about where that's going next year and in future years, we're looking at our most recent year performance. We're thinking about what's going to happen. We believe that inflation will continue at a very high rate. And we think it's important to share that with you in your evaluations. So we are increasing the maintenance rate to 7.5%. Now, for you as a client who is buying this property today, this is a great thing that we're sharing this in advance, right? Because at the end of the day, if our return projections need to be between 7 to 9%, and we have a cost that's going up, and we still are at 7 to 9%, we have to have a better deal somewhere else in that evaluation. So increasing the cost may mean that we're able to get more rent for the purchase price that you had, or maybe the property has lower taxes or something along those lines. So this is actually a good thing. And for any of our clients who have purchased in the past, just so you know, because we're raising the maintenance percentage on future purchases as an expectation, it doesn't change the expectation you had when you purchased. We are still held accountable to that 6% maintenance rate that we told you we were going to perform at for all of the clients that have purchased recently.
Got it. So that sounds like one of those quintessential data points that is being blended from past performance to present state to forward-looking reasoning. Right?
Absolutely.
Real quick, Michael Santorios has a question. Still have the septic annual fee, correct?
Do we still have the septic annual fee? You know, oh man, sometimes these numbers get thrown around in my head, and I should know that one, Michael, but I am drawing a blank on that one. Let me get back to you on that one. Come back on Thursday. I'll have a solid answer for you on that one. Okay. Man. Oh man. There you go.
That doesn't happen often. That doesn't happen often. That look of befuddlement on Gregg's eyes. All right. So Lee's got this question. Let's pop it in here because he shows up here every week. So let's give him some good value he deserves. Lee says, I am investing using a solo 401k LLC and want to know if I should be taking tax benefits on my personal IRS return from these 5 investment properties.
I am investing using a solo 401k, and I want to know if I should be taking tax benefits on my personal IRS return from these 5 investment properties. No, not able to do that. So when you invest in your when you invest in a solo 401k or a retirement vehicle, you already get these wonderful tax savings that we talk a lot about, right? We talk a lot about depreciation as being this incredible non-cash event write-off, which means that you just get to write it off whether or not you spent the money on things that may break in your rental property. The reason that you're doing that is that writes off other income that you earn, which is deferring that income. That's kind of the holy grail here, or trying to get to a place where we're deferring income. Well, for Lee and for others who invest in a solo 401k, within that vehicle, you already have tax deferral built into that. So the government does not allow you to double dip and take additional depreciation on assets that are purchased in your solo 401k.
There you go, Lee. Happy to be able to answer that question. All right, man. We got 5 more updates and we got 13 minutes, right? So we got to average less than 3 minutes per update. So let's go with number 3.
Appreciate it. And one more thing from the previous one, there is no change to maintenance percentage cost on new construction properties. You guys have been accustomed to seeing 4% as a maintenance cost for that. No change there. Our costs are actually lower than 4%. So if we're thinking about inflationary times, we've built in a buffer there, and we expect that for 4% for new construction.
There you go.
Vacancy. That is another big pain point, a reason why people get scared about investing in rental properties. On the renovation side, you'll see that number has increased from a 3% cost estimation to 4% cost estimation. And the reason behind this is that we are in the heyday of renting out properties right now.
Yeah.
We are in the heyday of low vacancy right now. And if you look at our metrics, our vacancy percentage is actually lower than 4%. But if we think about the next 5 years and beyond, chances are that it's not going to be this heyday of renting properties like it is right now, this limited supply and incredible demand. And so you would think that over time that percentage should probably go up. So again, building in buffers, our reno cost as estimation is going to increase from 3% to 4%, which is what you see on the evaluation right there for renovations. Now on the new construction side, no change. Same way of making this decision. Our vacancy percentage costs are actually lower than 3% right now. Building in a little bit of a buffer, of course, because we would expect the same thing to happen on new constructions as it would in renovations. But we are holding firm at that for a 3% estimation for vacancy cost.
Okay. That sounds like another one of these blended information, right? Like you could show someone a property eval of, hey man, right now it's 2.5%. And this is what we're going to put for the next 30 years. that's not what you choose to do.
Exactly.
You're adding in some life experience and some like current market stuff and forecasting in order to set right expectations. I like it. Let's move to number 4.
Number 4. All right. So this is going to be a pretty cool one. So we've looked at how we represent maintenance cost and vacancy cost in the first year. And if you talk with others, many people don't put any maintenance cost or any vacancy costs in the first year. The interesting thing for JWB is that we tend to have very little maintenance and vacancy costs. So if we want to zoom in there, you can kind of see
what row should I zoom in? You're better at this.
Yeah, you're doing great right there.
All right.
Actually, your column F and rows 20 and 29 are kind of what we're looking at. Yeah, perfect right there. So so prior to this update of evaluations, what you would have seen is a full year's burden of maintenance cost, right? It was 6% before for most folks, for renovated homes, or 4% for new construction. You would have seen that full burden in the first year. Chances of you having the full burden of maintenance costs in your first year as an owner of a JWB rental property is pretty slim, right? Doesn't typically happen because we sign long-term leases. Most of the time when you have maintenance costs, it comes during a turn. Just not very likely. So we were, being way too conservative there in our estimations. On the other side, on the vacancy side, we had 0% in for vacancy cost year one. Same mentality, right? You have people in long-term leases, the chances of you having any vacancy costs in the first year, very slim, but can it happen? Yeah, it can happen, right? So we said a better way to do this is in a more representative way is for us to add something in there for both. And so what we settled on is looking at the data for us. We saw that about 20% of your normal year's maintenance and vacancy costs would be in year one. And then every future year, you have that full balance of maintenance and vacancy costs. What this allows you to do is to have a great representation of exactly what you're going to see each year. And we set realistic expectations on both ends. We're not too conservative this way. We give some space to the fact that vacancy can't happen in the first year. And this just sets up our client service team and our new clients, especially, to have a great starting off point to understand what it's going to be like in the first year.
There you go. So as far as all of you fiddling around with this sheet at home, it basically went from using these numbers to using these numbers. Is that kind of what?
Not exactly.
No,
you're jumping the gun, man. You know the answers to the test.
Am I too far ahead of it? Okay.
You are. But if you go back to that analysis conventional finance tab,
I freaked out. Yeah.
Go back to column F.
Column F.
All right. If we're looking at cell C20, cell F20.
F20. Okay.
Yeah. It says negative $106.
Vacancy. Got it.
Before we updated this, that would have said $0.
Got it.
Okay. Now we're bringing into this and saying, listen, things can happen. It's not likely, but we're going to account for something. And that something is 20% of what normal vacancy would be there.
Got it. Okay.
And then if you look at F29, maintenance and repairs, that used to be the full burden. So it used to be 6% in this example, was a lot more than $198. That's unlikely. So it all evens out to basically about the same, but it's just a little bit more representative.
Got it. Okay. So we teased a little bit of where we're headed soon, but let's go to number 5.
Right. I don't know what that was.
It's okay. It's okay. It's all right. Everybody knows this is live television.
Oh, man. Number 5, we're going to talk about rent appreciation. This is a question that folks have asked a number of times. Greg, rents are going up 8%. Why on the evaluation do I only see 1% rent appreciation every year? Well, that's not real. So we have, over time, we have done that as a way to be super conservative. And we only put 1% rent price appreciation each year, but that's just not real. Even in environments where it's not the heyday of renting out properties, rents generally go up 3 to 4% a year along with inflation. So 1% was just way too conservative for us. And so what we did is we increased rent price appreciation up to 3% annually in our estimations. Now, that is still way conservative for where we are right now, right? You know what rents have risen year over year in Jacksonville?
Like 9%?
Yeah, 8-9%. Nice. And the number still is going up and up and up.
Yeah.
So yeah, way conservative. If we want to go to analysis conventionally finance tab, I'll show you where this is for those who are following along at home. If you go up to row 12, you can see that annual revenue increase. Revenue increase, that's just rent increase, right? Rental income coming in. And so that now is projected to go up 3% a year. And you can start to see how this affects your overall returns 10 years down the line.
There you go. All right. By the way, anybody following along at home, you want to download this sheet, you can go to jwbinventory.com and you can see all the past property of the weeks. This is last week's property of the week. Joanna, feel free to share that in the chat if you'd like. And now number 6.
Number 6. All right, let's talk about tenant placement fees. So tenant placement fees for us is, again, something that we have been overly conservative with, right? If you think about how tenant placement fees actually happen, you get a tenant placement fee when what happens, Pablo?
When somebody moves in.
When somebody moves in, right? So if somebody signs a long-term lease and then they have a very high likelihood of renewing, and that the average resident stay is 4.5 years for JWB,
yes,
which is what it is right now, how often do you see that tenant placement fee?
Every 4-point-something years.
There you go, right? It doesn't happen every single year. Well, previously, we included that in the first year. And if you include that in the first year, that's what would show up on the summary of returns. And when I would tell you we would get to 7 to 9% returns for you, that was including the full burden of that tenant placement fee, right? That's just not real, right? You don't get a tenant placement fee every year when you invest with JWB because our strategy is built on long-term leases, right? If you invest with other companies out there or you invest on your own in rental properties, you might see a tenant placement fee every year because you sign short-term leases and you're not good at keeping residents. This is our big value proposition, one of our big value propositions. So what we have done, and I'm going to combine 6 and 7 here, is we have taken the tenant placement fee and we have amortized it over 4 years, right?
So that's what we're seeing here.
Exactly. So every time we sign or we have a resident stay for 4.5 years, we're being a little bit more conservative there. And we're taking that tenant placement fee. If it was $1,000 for the rent, your tenant placement fee would be, $1,000 because that's equal to the first month's rent. And now we're saying the way that would affect your estimated returns is that you'd have one of those every 4 years. So the burden would be $250 in that example. And you can see here, the rents are $1,100 here. And you can see that the burden here in year 2 is $283.
Got it. You said you were combining number 7?
Yeah. Well, let me get there because then I'll kind of
With a
close the
question
loop
mark.
here because you're kind of seeing in year 1, $1,100 there. So I'll kind of explain this.
Yeah.
We looked at this and we said, listen, let's look at this from a fresh perspective. What our job here really to do is to take people beyond just year 1 returns, right? Again, this is a minimum hold of 5 years. If you're like me, if you follow my advice, right, you're going to hold on for a full market cycle. So our job really is to project and give accurate return on investment expectations over that minimum 5 years. The best thing to do is not to look at the year 1 returns, which have some extra costs like tenant placement fees and some costs that aren't there as much, like maintenance costs and vacancy costs, and move to year 2. Because once things settle down after your first year, that's where you get into the zone. And that's where you tend to see us hit those returns exactly the way that we project, right? You start to see that you actually do have maintenance and vacancy costs at some point over years 2 through 5. And you start to see that your tenant placement fees really are about a quarter of the burden rather than a full year's burden on an annual basis. So we have moved from year 1 representing what returns will be to year 2 representing what return expectations will be. If you're curious about this, the net effect of this is very similar, right? We were between 7 to 9% returns before. I don't remember exactly what our estimated return on investment is on this evaluation, but I'm guessing it's somewhere right around 7 to 8%.
Nailed it.
There you
Right
go.
around 8.38%.
There you go. So it is, the net effect of all of this is very minimal. But we felt like this is a great combination of preparing people for the future, also preparing people for what real life ownership is going to be year 1. Having that full tenant placement fee in year 1 equips our client service team to make sure that people understand that, in the first property that you purchase with us or any property that you purchase in that first month, right? It's going to be very low on cash flow. Even if it's rented, it's because your tenant placement fee is taken away, right? Those types of conversations help us have a better client service experience.
Woo, nailed it, man.
Did it.
All 7. I did the Ric Flair woo as a request from Bill Shields here in the chat.